What is liquidity in Forex trading? What is liquidity in Forex trading? Unlock the importance of liquidity in Forex trading and how it influences currency transactions and market stability for traders. Do you know that 84.9% of Forex market trades are in US dollars? This shows how liquid the Forex market is. It's the most liquid market in the world. This is due to large trading volumes and frequent trades. Liquidity matters a lot in Forex because it helps transactions happen without big changes in prices. So it's key for all traders. Liquidity means trades happen fast and smoothly. This offers quick order completion and smaller price differences. High liquidity is great for major currency pairs like EUR, USD, and USD/JPY. It means traders can buy or sell without much risk. But low liquidity at odd times or with less popular pairs means more risk. It's harder to sell your currency if there are fewer people buying. The Forex market enjoys unmatched liquidity, facilitating efficient currency trading. High liquidity enables faster order execution and reduces the risk of slippage. Major currency pairs such as EUR, USD, and USD/JPY exhibit high liquidity. Low liquidity can increase risks, making it difficult to close positions if buyers are scarce. Traders should employ liquidity indicators and analyze market trends to enhance trading strategies. Forex market liquidity is key for smooth trading. It allows currencies to be traded easily because there are lots of trades happening. Factors like global credit, economic happenings, and those who provide liquidity impact this. The Forex market has a daily volume of $2.4 quadrillion, making it the most liquid. This means traders can buy and sell quickly and at good prices, reducing risks. Common pairs like EUR/USD, USD/JPY, GBP/USD, and USD/CHF are very liquid, but pairs that aren't traded often are the least liquid. Forex liquidity changes with the world's economy, political events, and market times. Interest rate changes, big news stories, and economic surprises make the market more or less liquid. Liquidity providers help keep things stable by always offering prices to buy or sell currencies. Having more money for trading increases liquidity. If fewer people want to trade, liquidity can rise. Events like elections or disasters can change how much trading happens, affecting liquidity and prices. Changes in interest rates can shake up the market a lot. To be a successful Forex trader, understanding market liquidity is crucial. High liquidity means better deals and speedier trading. On the other hand, low liquidity can cause problems, leading to higher costs and unstable prices. This makes market liquidity a critical aspect to consider. Liquidity in the financial markets lets people quickly buy or sell things like stocks or money. Asset liquidity is key. It means investors can turn their investments into cash fast. Liquidity shows how fast we can turn something into cash without changing its price much. Think of the Forex market, where over $7.5 trillion trades hands daily. Here, financial markets liquidity is crucial. The US dollar, euro, yen, and other big currencies are very easy to buy and sell, making them trading liquidity leaders. Liquidity and market depth are very important in financial markets. They make trading easy and cheap, helping traders quickly buy and sell. This keeps prices stable, attracting more people to trade and creating a lively market. A market rich in trading liquidity is also less likely to suddenly change wildly. Good liquidity makes trading conditions steady, thanks to narrow bid-ask spreads. But in places where it's hard to buy or sell, like in small stock markets, prices can jump around a lot. Overall, liquidity makes markets run smoothly. It affects how cheap or easy it is to trade. Without enough market depth, trading gets hard, and prices can move against you. Many factors affect how easily Forex assets can be bought and sold without price change. Knowing these helps manage liquidity well. Changes in interest rates and money movement greatly shape the Forex market. Central banks adjust policies to keep currencies stable. For instance, raising interest rates attracts investors, boosting the availability of assets. Market interventions can also affect liquidity based on policy goals. The state of supply and demand influence Forex liquidity. More credit or less demand increases liquidity. The London and New York trading sessions show this with high volume transactions. On the other hand, periods of geopolitical tension see a drop in trading, leading to lower liquidity. Market players affect liquidity too. Retail traders and powerful institutions play different roles. Retail traders help during volatility, while institutions maintain a consistent transaction flow. Liquidity providers, including investment banks, keep the market stable. This is vital for smooth trading. Understanding these elements helps traders manage liquidity effectively in the Forex market. To be successful in Forex trading, knowing about liquidity in different pairs is vital. There are major and exotic pairs in Forex, each with unique traits. These affect liquidity and how much the prices change. Major pairs like 𝐸USD and USD/JPY are the most traded. They have high liquidity because many people buy and sell them. Since they are popular, they have low spreads. This means the difference between buying and selling prices is small. Trading major pairs is good for steady strategies like following trends or trading within price ranges. They are less risky because they are so stable. This makes their movements easier to predict. Exotic pairs mix a major and an emerging market currency like USD/TRY. They are less traded and more volatile. This means prices can change a lot, and the spread, which is the difference in buy and sell prices, is wider. Trading exotic pairs can be risky but also rewarding. If managed well, they can bring in big profits because of their volatility. For example, USD/RUB can be lucrative for traders who understand it. To master trading exotic pairs, you need solid research and a clear strategy. There are different trading methods you can use. It's best to start with one pair before trying others. This approach can make your trading in the Forex market more successful. The bid-ask spread measures the gap in prices in the Forex market. It shows the difference between the price a buyer wants to pay and what a seller is offering. This gap is significant because it affects costs and trade quality. In Forex, a high number of participants and lots of trading means the bid-ask spread is tiny. This tight spread benefits traders by cutting down on costs. Yet, in less active markets, like some stocks or futures, the spread can be bigger. This situation happens with assets that are less traded. A bigger spread means higher costs for trading and lower potential profits. The quality of executing a trade is also judged by the bid-ask spread. A narrow spread means smoother and cheaper trades. But in times of market stress, spreads might get wider. This change signals more risk and could cost more to buy or sell. Key players called market makers help improve Forex markets by offering bid and ask prices. By narrowing the spreads, they make trading more efficient. This process also helps them win more business. Knowing how these spreads work is important for traders. It helps them lower costs and make better decisions. Things like market activity, the trade size, and the currency type all matter. They can help reduce the impact of high spread costs and lead to better trade results. To do well in trading, being smart about both liquidity and spread costs is key. Staying on top of the market and using the right trading methods can make a big difference. Market depth shows how easy it is to buy or sell without changing prices much. It looks at how many trades are happening and the number of orders waiting. This tells us if the market can handle big deals smoothly. This section explains what market depth is in Forex trading. The volume of trades means the total currency traded in a set time. It's a key sign of the market's health. More trading shows there are many people buying and selling. But remember, things like wash trading can make it look like a lot is happening when it's not. Still, a high volume usually means it's easy to trade. Pending trade orders are orders not yet filled, like limit orders. They give clues on liquidity and market depth. A lot of pending trades can absorb big deals with little effect on prices. Watching these helps traders guess how easy it is to trade and plan their moves. Every hour in the Forex market has its own advantages. However, Times of peak market activity bring the most benefits. The New York and London markets meet from 8 a.m. to 12 p.m. EST, creating the best time to trade. During these hours, more than 70% of trades happen. This high volume means better conditions for traders. Now, let's see why this optimal trading period is key. The New York market runs from 8 a.m. to 5 p.m. EST and is second only to London. The US dollar is in 90% of all trades here. The London market, open from 3 a.m. to 12 p.m. EST, influences 43% of global trading. When these two markets overlap, things get better for traders. They find more market activity, smaller spreads, and fast trades. Increased market movement. Having several markets open can move currency pairs over 70 pips. A single market sees about 30 pips, showing the difference. Lower transaction costs. More liquidity brings tighter spreads. This means less cost for trading, which is good news for traders who are often active. Predictable price movements. Big trading volumes help predict short-term trends. This makes it easier to take advantage of the market activity during these times. Those open to trading at other times may enjoy the Sydney-Tokyo session, 2 a.m. to 4 a.m. EST. Here, there are more movements in the AUD and JPY pairs. Choosing to trade during these high liquidity hours is smart. It can make a big difference in your trading experience and outcomes.